Okay, well, good morning to everyone. Thank you for joining our conversation as part of the BRS Morningstar webinar series. Today, we're going to be focusing on the future of LRCN issuances in Canada. My name is Nadja Dreff, and I will be your host and co-presenter today. My primary responsibilities at BRS Morningstar are for Canadian insurance credit ratings. Joining me today as our guest speaker is Kris Somers. Kris is with Bank of Montreal, and he'll be providing us with a valued capital markets perspective. So I thought, Kris, would you mind telling us a bit about yourself and your role within the capital markets group?
Sure. Yeah. Thanks, Nadja. My name is Kris Somers. I work as a part of BMO Capital Markets. I've spent about a 15-year career working across various aspects from corporate development to equities and fixed income. And for the past several years, my primary responsibility has been within the debt capital markets group. So looking at funding and capital opportunities for companies within the insurance and telecommunications sectors. So very, very happy to be here to have this conversation.
Excellent. So let's dive right into it. We'll start by going through the presentation outline for today's talk. So the first part of the presentation will discuss the general LRCN market structure, capital treatment, and credit ratings. And then we'll get into the second part, which will be more of a conversation with Kris about recent market and regulatory developments. We will then conclude with an outlook for LRCN issuances in Canada, and then follow that with a question and answer period from our audience. I'll just remind everybody that you can type in your question into the question box located near the bottom of your screen. You can do that at any time or wait towards the end of the presentation, which actually is not going to take very long. So we're going to just get right into it. Again, I'm going to move over to our next slide. So this slide is really meant to answer the question of what are LRCNs? So they are a hybrid debt instrument. It consists of two parts, or two instruments, if you will. The first being the limited recourse capital note, which is a deeply subordinated interest-bearing note with a term to maturity of 60 years. It's issued to investors, in this case, institutional investors. And the second component are these perpetual, non-cumulative preferred shares. For banks, they would be NVCC, which is non-viability, contingent capital preferred shares. They are issued to a special purpose vehicle, or SPV, really held as collateral interest for the benefit of LRCN holders. Now, for banks, the NVCC preferred shares would convert to common shares upon a non-viability trigger as determined by the regulator. And for both banks and insurers, in the event of non-payment default, etc., the recourse against the issuer by the holders of LRCN notes would be the delivery of these preferred shares held by the SPV. So that's just an overview of what LRCNs are. I imagine the audience is largely familiar with those, and I wanted to just touch upon the capital treatment. The fact that LRCNs may qualify as a capital instrument, which of course is subject to OSFI approval. And if that's the case for a bank, this would be considered additional Tier 1 or AT1 capital. For life insurers, it's Tier 1 capital other than common shares. For P&C insurers and mortgage insurers, this would be considered Category B capital. When it comes to certain other limitations, as it concerns issuance size, etc., as well as redemption, those limitations do exist. And I think it would be best to invite the audience to look at the guidance provided by OSFI. As indicated on the page, they have a webpage on LRCNs, and there you'll also find certain other terms and conditions, such as the minimum maturity, which happens to be 60 years, the investor type, risk disclosures, and other such similar considerations. Okay, so we couldn't have this conversation without talking about ratings as well, given what I do. So let me just kind of start off by saying that LRCNs are currently the most junior in the hierarchy of debt issuances by Canadian financial institutions. As you will find in this table, we've had 6 insurance companies, most of them life insurers, issue LRCNs in the past. When DBRS rates LRCNs, we do so as relative to subordinated debt that is issued to these by these companies, and the notching is 1 notch below the subordinated debt, and the ratings are presented in the table here. Of course, banks have come to the market. In fact, the first LRCN ever issued was RBC in 2020. Many issuers have come to the market, actually multiple times since then. And then when it comes to the rating of NVCC additional Tier 1 limited recourse capital notes by banks, my banking colleagues will tell you that it is very much similar to what we do on the insurance side, which is it's the same 1 notch differential to the NVCC subordinated debt issued by the banks. Okay, and as I promised, so this is was very brief overview of the structure, capital treatment, and ratings of LRCNs, and brings us to the second and the better part of the presentation, where we will get Kris to chime in on recent market developments. With the background I just provided, I think, we would be amiss, of course, not to start the conversation with a brief discussion of the recent banking sector turmoil in the US. We've certainly had volatile markets. We've had some US regional bank failures in the past couple of months. So Kris, a question for you. What would be, in your view, the takeaways or lessons learned that we can apply to Canada?
Yeah, look, I mean, first lesson learned is that we're not allowed to take vacations during March break if we look at the financial services sector, right? Look, like more than any other industry out there, financial services is really highly interconnected on a global basis. So whenever there are any failures, it's important to understand the levels of exposure, direct, indirect, that the organizations have here. So in terms of kind of direct exposure to some of the turmoil that you mentioned, there's not really a whole lot that was material to any of the large financial firms in Canada in terms of direct exposure to either the U.S. regional banks or to Credit Suisse. This crisis, though, was driven by macro factors, namely rapidly rising interest rates, and that kind of eroded asset value on the balance sheets of some of these companies. So it did drive a bit of weakness in markets across the broader financial services space. And this unprecedented change in rates and subsequent change in bond values really highlighted the strength or the weaknesses of financial institutions' risk management practices. To get a bit more specific on that, a lot of the struggles that were faced by the regionals could probably have been avoided by properly hedging interest rate risk. If it wasn't for this, I don't think that they would have been as exposed to the liquidity challenges that they ended up with, and leading to those unfortunate outcomes. In terms of Credit Suisse, I mean, this is a bank that has faced challenges in the past and has been on shaky ground a couple times. So when the broader confidence in the sector was questioned, Unfortunately, they weren't strong enough to survive this. So I guess coming back to your question of what are the lessons that are learned here, I think it shows the importance of having really a great management team at the helm, having fortress levels of capital and great regulation. And I think, Nadja, these are things that all exist in spades in the Canadian financial institutions.
Great and very insightful comment. I think I'm going to move on to kind of like the second bullet here and ask you more specifically now vis-a-vis the Canadian capital markets. How would you characterize the current state of the Canadian capital markets, specifically as it regards to debt and capital issuances more generally?
Yeah, I mean, for particularly in the investment grade space, I'd characterize the debt markets as actually kind of quite healthy here in Canada. I mean, we've seen about almost $43 billion of bond issuance so far domestically. Canadian domiciled issuers, so that's Canadian companies, have been able to raise more than $160 billion on a global basis. So definitely still quite healthy, good access to funding and capital for most of our issuers. Corporate bond issuance is up more than 15% versus last year. So again, like this just highlights the appetite of investors for Canadian debt products. For a first part of the year, I mean, the non-bank levels of supply were kind of trailing a bit, but as stated, like we're kind of a little bit north of 15% higher now. Activity's been great, momentum is strong, order books well oversupplied, new issue concessions have come down, and we've seen positive secondary performance in almost all cases. So all this kind of indicates back to investors having strong amounts of cash to be able to kind of come back and put to work. Admittedly, the issuance from the financial services sector itself is down a bit year over year. A lot of these companies do have access to other global markets, and so there has been some kind of shifting around in terms of currency mix. But activity has been picking up a bit in the recent weeks and months with including some well-subscribed subordinated debt offerings from a couple of the large banks. So definitely seeing a pickup in tone here.
Okay, sounds relatively optimistic. So let's keep it that way.
I try to be optimistic, Nadja. I try to be optimistic.
It's appreciated very much. I think we better bring it back to LRCNs, right? So keeping that focus, let's discuss in a little bit more detail this unique situation, if I can put it that way, involving Credit Suisse and the subsequent default and complete wipeout of their AT1 instruments. So I guess the big question here is, are these AT1s that were issued by Credit Suisse in any way like our Canadian LRCNs? Can you speak to us about the differences?
Yeah, I think hopefully I don't get too detailed here, but I mean, I think what caught a lot of folks by surprise was the complete write-off. So the zeroing of the value of those Credit Suisse AT1 bonds, despite theoretically them ranking higher than equity, and equity getting not a whole lot of value, but getting some value when UBS came in and took them out. But when I read the Credit Suisse AT1 documents, I mean, this is exactly the way that this was supposed to happen. There's hard triggers that exist in that security, that if capital falls below a certain level, if the government has to provide support to the bank, there's explicit language in the documents that show that these AT1s would get written down to zero. So this was definitely something that a lot of investors were looking into as it relates to the Canadian AT1 market, but our securities are different and really would result in a very different outcome in this type of situation. So our notes, as you mentioned, the limited recourse capital notes, they do come in two distinct flavors. The first is the large banks issue LRCNs that are subject to non-viability contingent capital considerations. And these words mean that there's a trigger conversion to equity, so not a write down, at an event that the regulator deems to be, if the regulator deems the firm to be non-viable. But the important thing there is this is not a write down to zero. It is a conversion to equity that is calculated in such a way that it dilutes the equity holders and maintains that level of waterfall hierarchy for the LRCN securities. Now, for the companies that issue LRCNs that are not non-viability contingent capital, or NVCC, these are still very junior securities, and they would provide loss absorbency in the event of an insolvency along a normal waterfall of hierarchy. So to come back to your question about could something like this have happened in Canada? I mean, structurally, it wouldn't have happened the same. The mechanics of our instruments do not force a write down to zero, like the Credit Suisse one did. And the regulator even actually went so far. So OSFI went so far as to release a statement indicating that they would respect the hierarchy of claims in any intervention related to AT1 or Tier 2 capital instruments. So kind of said differently, there would not be a situation where the equity holders received a higher amount versus what the Tier 1 holders did in a liability event. So I don't know if that answers your question, Nadja.
Absolutely does. And thank you for shedding some light on that situation, talking about the differences and what transpired, because certainly the investors, I'm sure, had a lot of questions. I know for a fact we all were kind of looking at that situation and wondering that same thing. So good to hear it from you, and that kind of clarification is very helpful. But given everything that transpired, these events certainly shook the markets to the core. Can you talk to us what has been the situation, or specifically have we seen LRCN or AT1 capital issuances since March? I think I know the answer for Canada, but tell us anyways. And then if you can also provide some comments on globally what the situation's been like since March.
Yeah, I mean, there hasn't been any LRCN issuance in Canada or in the US following the kind of headlines related to regional banks and CS. And but with more than $28 billion of LRCN issuance in the past few years, most of the large financial companies are in extremely well capitalized positions, and I don't actually need more Tier 1 capital. Looking globally, I mean, there's some green shoots forming. There've been a couple of Tier 1 like securities issued in some jurisdictions. There's a Japanese bank that did one. I think Royal London did one as well. But it's less of a capital need, I think, from the companies right now. So we haven't seen anything come back. And then certainly from a pricing standpoint and demand standpoint, there's maybe a bit of shyness, I'll call it, around the space. But I do expect it's going to come back as markets continue to firm up here. But as I mentioned earlier, I mean, we are seeing a return of Tier 2 capital. Deals are getting priced on both sides of the border. They're being well received. Subordination premiums are aligned with pre-turmoil levels. So this is really encouraging investor receptivity, and I think is going to continue to drive momentum in the regulated capital space.
Excellent. I think you already kind of hinted at the outlook. We're going to come back to that question in more detail. But before we move there, I prepared kind of like a list of select, by no means exhaustive, overview of recent regulatory developments that may concern the demand for LRCNs. And so I'm wondering if you could discuss these, if in your view, you believe they alter issuers or investors' demand for LRCNs.
Yeah, I mean, I think that one of the big ones here is that the rules for P&C and mortgage insurance companies have kind of shifted a little bit, and there's now capacity for these companies to issue our LRCN regulated capital. What this does is this gives some of the smaller players that maybe haven't issued capital in the past access to third-party capital for the first time. And a lot of these are names that may not be as familiar to the investor market, but as this space continues to develop, I would assume that that availability of third-party capital actually grows for these companies. And over time, this is going to provide very attractive investment opportunities, particularly for sophisticated buyers that understand the space and understand the structure, and it'll provide a new source of capital for those insurance companies. So those are sort of the first couple points on there. I mean, I think that the final point on dividend taxes, look, early days on this one, and I probably I would say a bit too early to comment. As the rules are written, this will take place early next year, I believe. But again, I think a bit early to comment on how that's going to impact things.
Yeah, fair enough. At this point, it is the latest of proposals, and it's only a proposal. So let's see how that proposal develops and evolves. And just like I promised, we will be talking about the outlook for LRCN issuances. So let's move on to the next slide. A little bit small for people to see, but what this is just historical volume of LRCN issuances by banks and insurance companies. As you can see, 2020, we had all banks, then insurers joined them in 2021. The history is rather short. 2023 year to date looks pretty thin. My question to you, Kris, is what is it going to look like by the end of the year? Your best guess?
Yeah, I mean, look, like as you point out, I mean, the LRCN market was really active from 2020 through to 2022, and this is when this asset class was first kind of formed, and all of the large financial companies were active in it, and they went out and they raised the tier one capital, and again, this is permanent levels of capital. Certainly doesn't need to refinance in another year to come. So that was kind of a one-time jump, I think, based on the rule change and based on the creation of this type of security. As governments began raising rates, I mean, certainly that impacts pricing. So LRCNs would have been more expensive. I mean, through 2021, I think the average new issue yield on an LRCN was around 4%, versus in the back half of 2022, we're up north of 7%. So significant difference in cost there. So while I do still believe, I mean, the driving force for capital issuance is whether or not the companies need the regulated capital, which at the current state, everybody's in a very good position. But at the same time, I wouldn't be surprised if the LRCN issuers were content sitting on the sidelines until conditions do get a little bit better, just given the big move in rates there and the big move in pricing. So, but I think when I say, well, what does 2023 look like? I come back to the math and the OSFI regulatory capital, and there's really everyone's in a very good position. So unless something was to change as it relates to the regulatory capital rules, I would not expect to see a large amount of issuance through the remainder of the year.
Okay, well, thank you for that very thorough answer and analysis. Very helpful for our audience to have a feeling, what are all these different factors that really play into whether we're going to see more and how much more of LRCNs in Canada. But I think that more or less brings us to the end of the presentation. Here's our disclaimers and such. And we move on to the question and answer period. I see we already have a few questions that came in. I think I'm going to go first with the second question that we received. It reads like this. Okay, now do you expect low reset LRCNs to get extended at first call? What circumstances would be necessary for them to be called at first calls? So in other words, do you expect LRCNs to get called?
Look, I think that the regulator was quite clear in their guidance around really thoughts of redemption around LRCN. So OSFI has given a specific guideline that for the regulated capital issuers, if they were to, the only way that they would be able to call these securities is if a cheaper form of tier one capital was available for them immediately following. So in other words, they view the LRCN capital as a permanent part of the capital structure and don't want to see these redeemed unless there's an opportunity to save a significant amount of money afterwards. And that's straight from the regulatory guideline. And so I think that when thinking about expectations, it would make sense to think about it along those lines.
Yeah, absolutely. Here's another very topical question. Will all the old prefs or preferred shares be taken out of the market and refunded with LRCNs? I think that's a pretty popular question we also get. What are your thoughts?
Yeah, I mean, look, like quite frankly, you'd have to ask the issuers themselves how they view that and how they want to treat those. I mean, maybe I'll talk about the history there, where there was certainly a lot of preferred shares over the past 10 years that were taken out of the system because of the fact that the government started to ask for these NVCC provisions on all their tier one capital. And so you started seeing preferred shares, legacy preferred shares being replaced with NVCC preferred shares. So those are modernized and fit within the current regulatory framework. So in terms of whether or not all of the old, I find it very hard to believe that all would ever get called. But again, you'd have to speak directly to the issuers to learn their intentions on those.
Fair enough. Again, lots of different considerations go into companies' decisions. So we have a question where you're being asked, Kris, if you could comment on the theoretical repayment at maturity versus conversion to preferreds in a non-distressed situation.
So this is, I mean, in a way, this question is asking me to predict something 60 years in the future. So I'll try. So the question, I mean, the maturity of an LRCN is 60 years. And so at that point, I mean, a repayment at maturity, I would assume that the issuers have the option of either repaying, replacing with new capital, or converting to preferred shares by delivering those trust assets to the investor in lieu of repayment. I think that's a tough one to answer, just given when we look. I mean, I always used to say there's three sure things in the world. There's death, there's taxes, and there's changing financial regulations. So 60 years from now, will the rules around tier one capital be the same? I mean, I don't know. I know these things are designed to be permanent capital, but I think the pace of change that we've seen throughout the past, call it 15 years in particular, at least as long as I've been watching it, has been quite rapid. So commenting on intent and treatment 60 years from now it's a tough thing to do. There's a lot of things that can change over that forecast period.
Granted. So I think we're close to the end, but and there's more questions than we can answer, but I think I'll take one that's more of like a banking and then another one that's more of insurance. So see if we can answer them both. So the first one asks whether a bank could call an LRCN and not replace it especially if their capital structure doesn't require it?
Yeah, I think that is a question that would require a conversation between the bank and the regulator. Again, like my interpretation around the rules as it sits today is that banks would have to, even if market prices are more expensive, I think that they would have to either keep it outstanding or replace it with something cheaper. That's the way that I read the regulatory language.
Right, and that's kind of written in the rules, under what conditions. So again, I would invite people to visit the OSFI website, where those rules are kind of described. Kris, maybe if you have time just for one more question. And this one asks if there are any known mechanisms in place in Canada to issue LRCNs for financial institutions that do not typically raise external capital. And in this question, the person's referring to, for example, mutual insurance companies or credit unions.
Well, I think some of that comes back to, as I mentioned earlier, I mean, there's some rule changes that allowed some of the companies, I think, within the insurance space to begin raising external capital via LRCNs. I don't know that any of these transactions have taken place because I think partially because of the rapid move in pricing. But that is a change, and quite frankly, I'm less familiar with how the rules would work for credit unions there.
Okay, well, I think we did our best to shed some light on the market and provide our outlook to the extent we can. So I think at this point we're at the top of the hour. So I'd like to thank our audience for their questions and for tuning in. Remind everybody that they will receive the slides that we just discussed via email. And at this point, I'm going to thank my guest speaker. Thank you very much, Kris. Pleasure to have you within our webinar series, and hope to see you again soon.
Great. Thanks a lot. Thanks everybody for listening.
Thank you. Bye-bye.